Oh, cool. Okay. All right, let's get started. Well, for you guys who don't know me, my name is Tanner Garver. I am the new lender in the office. I came from Fairway Mortgage. I just started a couple weeks ago. I've talked to kind of some of the team meetings, and so I'm sure you guys may have seen me or seen some of my emails that came out. So nice to visually meet you. I can't wait to meet y'all in person, see your faces, and really get to know you. But today I just wanted to go over kind of what the process is of a mortgage, right? When you guys get into a contract, it's kind of a big piece of what you're doing, just knowing the background. And most of the time you just have to get it to us. We'll take care of it. But it's nice to at least know what's going on so you can talk to your borrowers and figure out how they qualify, kind of an idea of what's going on. So today, we'll go over simple, what is a mortgage, what determines a budget for them, because a lot of people, your buyers want to know what their budget is, what they are looking at, different mortgage terms, the loan process, and then just any questions that you have. And like I said, guys, there's not very many of us on. I want this to be informational and kind of add value to where you guys have questions. And so any questions you have, stop me in the middle of me talking, ask away. I want to answer everything I possibly can for you so you kind of know and take some objective away from today. So, all right, getting started. What is in a mortgage? What is a mortgage? And one thing you can remember when you hear mortgage, it is not simply just paying off your loan. If you remember the statement PITI, it is principal, interest, taxes, and insurance. We say PITI in the mortgage world. And so principal, interest, taxes, and insurance. And what this is the principal and interest is just like any loan that you're paying off. You pay principal towards the house and you're actually paying off the house. The interest is the interest rate. You're paying off the interest for the loan. And then you have your taxes and your insurance when you pay a mortgage each month. And so only about 30% of what you actually pay in your mortgage payment goes towards your paying off your house. The rest goes towards everything else. The taxes and insurance piece. Have any of you guys ever heard of an escrow account? Because I'm interactive, so if you're not interactive, that's fine too, but just tell me so I can stop being interactive. Have you guys ever heard of an escrow account?
Yes, I have.
Okay, so what?
Yes.
All right, so when you hear escrow, what do you guys think of? Come on, Emily.
Oh, am I off mute now? Okay. Like the insurance and everything for your house.
Yeah, it's a great way to put it. So when you think of escrow, just think of a big savings account. And so essentially what it is when you make that principal, interest, taxes, and insurance payment each month, the principal and interest goes and pays off the house, where the taxes and insurance when you pay each month goes into what's called an escrow account or savings account. And so each year when your taxes come due, in Kansas, it comes due twice a year, in April and in December. And in Missouri, it's only once a year in December. When your taxes come due, it's paid through your mortgage, and your mortgage company pays you for it. That money is just sitting in this savings account. When you sell your house, you will rather get it back, or it will come off the amount that you get it closed. Or when you refinance, like this money is yours. It is just in this savings account, so you don't have to worry about it and have a problem where you miss your taxes each year. When you close on a house, the mortgage terms will collect in your closing costs what's called prepaid items. We'll get to that later, but they'll collect prepaid items where you set up an escrow account and they put an extra 2 months of reserves in this escrow account. And so in case your taxes or insurance go up at the end of the year, which most of the times if you bought a house and add any value to it, it will go up. They have that in there so you don't get hit with a payment shock. And so in this escrow account, you have your taxes and insurance that get paid each year. And so just remember that when your borrowers ask, what's escrow? What's my payment? Just think savings account, just big savings account. So when you're talking to a buyer, it's kind of what I go over each time, is what every buyer wants to know. How much can I afford? What my down payment is? What will my monthly payment be? How long will I be owning? And it's just stuff that are things that every single buyer will ask. And so what we go when we get into the mortgage process is we go over each qualifying factor first. And I walk them through each of these to break down each of these main questions. And so they know what they are looking at before they come to you guys and what they're pre-qualified for. And so when you qualify for a mortgage, there's 6 main things that we look at. The very first thing is income. There's a lot of different ways to calculate income. Basically, we take if you're a W-2 employee, when you calculate income, this is good to know. If you're a W-2 employee, we just take whatever your salary is. And so if your salary is $60,000 a year, we take that $60,000 and divide it by 12 months, and that is what your income is. If you are a hourly employee, we take your hourly rate, multiply it by 40 hours a week, and take that times 52 weeks of the year to get your annual salary. Where it gets a little bit different is, for instance, if it was one of us, if you are a 1099 employee, we take a 2-year average of your reported income on taxes. So your 2019 and 2020 income for this year to qualify for a mortgage. And that's the after expenses on a 1099. And so we would take for instance, let's say you made $100,000 last year, but you only reported $60,000 to qualify because you wrote off $40,000 in expenses for 2019. In 2020, you made $120,000. You wrote off another same $40,000, so you had $80,000. And so you had $60,000 in 19, $80,000 in 2020. What you would use for qualifying income is that $70,000. Does that make sense? So for a 1099 employee, you take 2 years history of their income to report it. All the others, commission, you take a 2-year history as well. And every other income anything that's not just a salary or hourly, you would take a 2-year history. Does that make sense? After that, we go into debts. Anytime you pull credit and debts almost essentially go together. And so when you pull your credit, we see what your debts are. So you see your monthly debts, any student loans, credit cards, car payments, anything that you've added debt on, a collection, we see that as the mortgage people. Why do we see that? Because the way that you qualify for a mortgage is what is called your debt to income ratio. Okay. And this is where it gets kind of tricky. If we were here, I would draw it all out. But when you hear debt to income ratio, there's a lot of different factors that go into it. But the main thing to remember is you take all of your monthly debts. And so your credit cards, your student loans, your car payments, anything that you have money on and owe on, you take the minimum monthly payment on that. And you add that plus the new mortgage. And so you have all your minimum monthly payments plus the new mortgage that you will be buying a house on, divided by your gross income before taxes. Okay? You guys follow me at all? It's tough. It's kind of confusing. So you take all of your minimum monthly payments. So for instance, $35 a month on your credit card, $120 a month on your student loans, $200 on your car payment. So that's $335 plus your new mortgage, which let's just say $1,200. So you have $1,500 in debts that you owe monthly, divided by your gross income before taxes. So if you make $60,000, that's $5,000. So you take those two, everything combined, and that's how you get your debt to income ratio. Does that make sense? Mm-hmm. That is how you can figure out what the max you qualify for. For a conventional mortgage, you qualify up to 45% debt to income ratio, meaning all of your monthly debts plus your new mortgage divided by your gross income before taxes can go up to 45% in order to qualify. For FHA, that number can go all the way up to 50%, and in some cases it can go over 50%. VA and USDA can go up to 50% as well. So that's why people, first-time home buyers, a lot of them get FHA loans because their debt to income ratio is higher because they're not making as much money right now. Does that make sense? They'll lose some of you that's debt to income. It's not that fun. That's how you get qualified. Credit, we'll go into credit here in a second. Employment history, when you're employed, you can't have any job gaps within 2 years. If you're a 1099 employee, you have to have a 2 years history to qualify. Otherwise, you can't qualify. We can't use your income for qualifying. But if you are salaried or you have a job offer, this is a big one. Let's say you're just graduated college, you have a job offer. If you start within 60 days of closing, then you can use that income for qualifying. So let's say you close on your house on July 1, you start a job August 1st, you can use that as long as you have a signed offer letter, what your salary is, you can use that for qualifying income for a mortgage. So that's how you have people that move to Kansas City or that are starting a new job, you can use that income for qualifying. So it's one thing, no property, that's just going over everything with the property, making sure that the appraisal comes in good, that the house is inspected, basically just making sure the appraisal is good. And then when qualifying for mortgage, it's just making sure that you have enough for the down payment, the closing costs, the prepaid, and the cash reserve. So when you qualify, you have your down payment. So let's say you buy a $200,000 home, you're putting 10% down. You have to have that $20,000. Closing costs, you usually have around $2,500 to $3,000 in closing costs. And then you also have another $2,500 to $3,000 in prepaids. And what the closing costs are is a one-time lender's fee. Ours is right now, I believe it's $1,195. And then you have a miscellaneous title fees. Getting your name on title is around $1,000. Getting it recorded in the county is around $1,000. And then you have to pay for your appraisal at closing, which is $500. And then just a few other miscellaneous items in closing costs. Prepaids, what prepaids are, is you are setting up that escrow account, what we talked about earlier. You have to collect that 2 months of prepaid taxes and prepaid insurance in this escrow in case there's an increase, you can have that. So you collect 2 months at closing just sitting in your escrow. That usually equals about $1,500 to $2,000 right there. So what I always tell people is always include your down payment, whatever your down payment is, 5%, 10%, and usually add $5,000 to $6,000 on top of that, and that is how much you will need for a mortgage. So if you buy $200,000 house, put 10% down, you're going to need around $26,000 cash to close. You also have to have 1 month's reserves in the bank to qualify. So you have to have $26,000 plus that $1,200 in case your mortgage, for that mortgage, you need about
if they're putting 10% down.
Yeah, to put 5% down, then it will be $10,000 plus that $5,000 to $6,000 in closing costs. So it'll be $15,000 or $16,000. Plus you have to just show reserves, and so then it's about $18,000. Does that make sense?
Mm-hmm.
So basically, whatever they want to put down, just add $5,000 or $6,000 to, and that is what they will need cash to close. Something to remember when you're talking to them. Any questions so far? Silence. All right, we'll keep going. How much can I afford? Kind of the exact same thing I just went over. The debt to income ratio. This is what determines the budget for your buyer. Debt to income ratio can go up to that 45 or 50%. They have to have as much for the down payment plus that reserves that we just talked about. They can't have a bunch of outstanding debt because that ruins their ratios. Their credit score is a main factor in this, as I'll get to that in the next slide. We'll just go to it now. And so credit score is huge. Everyone wants to know their credit. No one wants to do multiple hard pulls on their credit, right? Everyone wants to have the best credit possible. When you have your credit, anything above 740 in the mortgage world is optimal, meaning you're in the green. It says 750 here. Yes, that's very, very good. If you're above 740, you will get the best rates possible that a mortgage lender has to offer. The higher you get, the better your PMI or mortgage insurance is, which we'll talk about in a second. The higher your credit score, the better it helps your PMI. But anything above 740 is optimal. To qualify for a conventional mortgage, you can go down as low as 640 to get the rates to be good. We try to keep people above 680. So if you're above 680, we will try to get you into a conventional mortgage. If you're above 620 to 680, that range, we'll probably put you in an FHA mortgage. The minimum credit score you can have in a mortgage is 600 right now, is the lowest that you can go. Some companies allow 580. A lot of people, including Fairway, raised that bar during COVID a little bit because a lot of people went to forbearance. So right now, our minimum that you can go down to qualify for a mortgage is 600. So anywhere, if you're 600 to 680, we will probably put you into an FHA loan. Anything 680 and above, we'll put you in conventional. If you're above 740, you'll get the optimal rate and the optimal PMI. Does that make sense? So this is your credit score. What goes into credit? A lot of it is you have your payment history, a big part of it, making sure your payments are on time. Amount owed is a huge one. For credit cards, you want to have your amount owed less than 30% of the utilization. And so if you have a $10,000 limit, a hot max limit on credit cards, you want to keep your utilization under $3,000 or pay it down to under $3,000 when you get the mortgage. And so we can show that your credit is paid down, your utilization is low. A lot of people, one thing you can tell your borrowers, it's not always great to pay off your credit cards, pay off your collections, pay off everything. We always tell them, let us pull your credit, check your credit first before you pay off anything. Because sometimes if you pay off a collection, I just had it happen last week. If you pay off a collection, it can drop your score actually by a tremendous amount because you have an installment loan that is now off your credit. And so you can drop from, I had a person that qualified at I think it was a 618. So not great, but he qualified for an FHA mortgage, paid off his collection. We looked at his new credit report, it was 570. Can't qualify anymore because he paid that off. And so before you have people just start paying down their credit to try to get qualified, have them talk to a lender because we can put them into different programs. We can help with that and give them what's called a quick score to where we can pay it. They can pay it off, send us a letter, and we can send it to a credit company. And within a week, their scores change. And so before the people say they want to fix their credit and get all better and get it better on their own, have them talk to a mortgage lender, someone that can pull and look at it and give them advice before. Okay. Matt, you jumped on. What's up, brother? Come on, say hi, Matt. Get off the mute. Say hi.
Hey, sorry about that.
There we go. Does anyone have any questions too? I feel like I'm just preaching.
Oh no, I'm just enjoying the show, learning a lot.
All right. Well, you guys have any questions? Stop me. Some things to do for your credit is keep it monitored. Each year you can have one free credit report pulled at annualcreditreport.com. If your borrowers are worried about that, they don't want to have party checks, you can have one free credit report on it. Obviously, pay all your bills on time. Don't close revolving debt, meaning if you pay off a credit card, if you only have 2 credit cards, don't pay off one of it completely and close it and cut it in pieces and be done with it. Leave it open, but have $0 on it, and it actually helps build your credit. And that is really it on credit. Main thing to remember with that, anything above 740 is optimal. Anything above 680, we will go conventional. Anything below 680, but above 600, we will go FHA probably. And I say probably because there's those rare cases where right now you would want to have a conventional over a FHA, and if you're 650, we may put you conventional with a higher rate. Rate is determined strictly off your debt to income ratio and your credit. So, and how much you put down. So that is all on credit. We'll just go over some different terms real quick so you guys can kind of understand it. Been talking about it a lot, debt to income ratio. Gross monthly income. So if you have 2 people apply, this is something that it's good to know. Let's say you have a husband and a wife apply. They both make $5,000 a month before taxes. Their total gross income will be $10,000. We will use that number for qualifying. You can have as many people as possible on a mortgage to qualify. There's no rule. You can have 10 people on a mortgage if you wanted to. I'm not saying do it. It'd be kind of nuts, and title would be absolutely mad to get 10 people on a mortgage, but you can do it. So your debt to income ratio is all of those monthly debts. So both people, the husband and the wife, all of their debts combined divided by their gross income before taxes. And that is, you can go up 45%, like you keep reaching for conventional, 50% for FHA. Loan to value. You will hear this one quite a bit in the mortgage world and the real estate world. What loan to value is the percent that you are putting down. And so it's amount that you owe to the value of your home. For instance, let's say you put 5% down on a home, your loan to value is 95%. You put 10% down on your home, your loan to value is 90%. Okay? The magic number that you always hear is you want 80% loan to value. Does anyone know why you want 80% loan to value?
No.
I got someone in the crowd saying no. Here, you get a treat. I'm just kidding. All right, Matt, why do you want 80% loan to value?
It doesn't ensure to the bank that the house is they're going to be able to recoup the value in the event that the loanee defaults.
Exactly. So yes, long story short, absolutely correct. If you put 20% down, you don't have to pay what is called PMI. And your borrowers always hear PMI and they get extremely stressed out about it, right? Because in the older days, PMI, your interest rates were around 10%, and then you have to pay PMI on top of that. What PMI is it is insurance to the lender, kind of what Matt was saying, insurance to the lender for putting down less than 20%. So you are insuring yourself, showing that you are stable by getting this PMI. It is required for any loan that has less than 20% loan to or down payment or 80% loan to value. Does that make sense? And so that number can vary. The more you put down, the lower this number is. If you put the minimum 3% down on a conventional loan, your private mortgage insurance is going to be around $150 to $200 a month. You put 5%, it'll probably be around $125 to $150, depending on the size of the house. It's based off a percentage of the loan amount. And so the better your credit and the more you put down, the lower this PMI is. One thing that is very common right now, you hear a lot of people refinancing, right? Why are they refinancing? Right now, as you guys know, the value of homes are going up tremendously, right? They're appreciating by $20,000, $30,000, $40,000, $50,000. It's nuts, right? So when the value of your home goes up, let's say you bought a home 3 years ago at $200,000, right now, the same home, you can probably, the value of it's probably around $250,000, right? Your loan to value bases off that value of your home. And so if you put down 3% or 5% on a $200,000 home, your mortgage started at $190,000, you paid it for 3 years, you're at $185,000. The value of your home's now at $250,000. You refinance and you don't have to pay PMI anymore. So why is this important to you guys? Why do you need to know what PMI is? Because it scares a lot of people, first-time home buyers especially, scares a lot of people out of buying a mortgage. I will tell you this, it is not as expensive as it used to be. For when our parents bought a home, interest rates were 8 to 11%, right? And if you didn't put down 20%, your PMI was also around that 5%. So you're paying an extra $300, $400 a month in PMI. A lot of money it went to PMI, and your interest rate was really, really high. So they always said you have to put 20% down to buy a home. Right now, if you put 3 or 5% down, your PMI says $150 to $200 a month, depending on the size of the home. So for $150, instead of putting down $40,000, you're putting down $5,000, and your loan and your value of your home is going to go up. We can get people off. If you have someone that is putting down 10% on a house, we can do what's called a one-time mortgage insurance premium or a one-time PMI payment, where for $3,000 or $4,000 total, we add it to the top end of your loan, finance it into the loan, and you don't have PMI anymore. You just add $3,000 to the top end, your PMI is gone. So PMI, it's really scary for first-time home buyers. They always hear it because they hear their parents. I'm telling you, it is not as big as it used to be. I walk through all my borrowers, showing them exactly what their PMI is and showing them how quickly you can take it off. One thing to remember with PMI is it falls off after you hit the 80% loan to value mark or after 10 years of holding your mortgage. So after 10 years, that payment falls off forever. Or for instance, let's say you buy a home, keep going to 200,000, you buy a home for 200,000, you flip it or you add value to it. You redo a bathroom, you redo a kitchen, you redo a master bedroom, all of a sudden the house is worth more. Refinance, your PMI falls off because you've added value because your loan to value changes. Does that make sense? Mm-hmm. You guys follow me? Any questions?
No questions.
Cool. Oh, Kaylee, thank you for responding. Yes,
You're welcome.
I'm like really energetic. I like talking to people and no one's in here. I'm like, oh, whoa, whoa. So when you guys respond, it makes me happy. But so yeah, that's a big thing with PMI. Some do's and don'ts. Do's, what you want your buyers to do. Make sure that they, my screen looks weird. Keep everything. Have access to all their bank statements. We have to verify their income, assets, employment, and history. I'll get to that in a second. So make sure that they have access to their bank statements. Make sure that they keep a copy of their earnest deposit fund so we can see it. If they receive a gift, let us know. Main thing, this one's huge. make sure if they have an employment change or a raise or promotion that they let us know, because that can change their debt to income ratio. Or if they switch jobs. A lot of times this happens in the healthcare field. If any of you guys work with any nurses, make sure that they don't switch from full-time to PRN, because that's a part-time job and you have to have 2 years history. And so it's very important when you're talking to a nurse buyer or someone in the healthcare field that you ask them, or they know, and I do this, but it's nice for you guys to know too, that they need to be rather a full-time nurse or have 2 years history of being PRN or part-time or travel, because they have a lot of different restrictions when it comes to that stuff. So just something good to remember. Some don'ts when you apply for a mortgage. Don't close any accounts before you talk to us. That's kind of what we talked about before. It can change everything. Don't deposit any money outside of the normal payroll deposits. So if you have any large source of funds, so for instance, let's say you get $5,000 cash. If you have cash sitting around, the buyer has cash sitting around, they're going to use cash for a down payment. You have to have 2 months history of this cash in your bank account in order to qualify with it. So you can't qualify, just say, I have $5,000 cash to be underneath my mattress. I'm going to use that for a down payment. You can't use that for a down payment unless it's been in your bank account for 2 months. And so you have to have a history of 2 months of where the money originated from, or a gift letter showing that it was a gift in order to use it for qualifying purposes. Does that make sense?
Does it still have to be in the account for 2 months if it was a gift?
If it's a gift, no. Great question. If it's a gift, you just have to get what's called a gift letter, which is super easy to fill out. If it's a conventional mortgage and a gift, with a conventional mortgage and a gift, you just need a gift letter and a copy of the check that they wrote for the gift.
Okay.
If it is a FHA loan, you have to get a copy of the check, and then you have to get whoever gave you the money, their bank statement showing the money leaving, and your bank statement showing the money came in. And it has to be the exact same amount on each of it. Does that make sense?
Yeah.
So you just have to trace where the money came from.
Right.
So as long as but with a conventional mortgage, you just have to get a copy of the check of the gifter, and then that's it. Do you have a question, Kaylee?
No, I wanted to make a comment on this. I have been in a situation where my client had an FHA loan and she was given a gift, and they had to prove, I guess they saw that the money was deposited in the bank account, so they had to go through different types of streams to prove that money. So it was a little bit more difficult of a process.
Oh yeah, it's very difficult to get a gift with FHA. Thank you for sharing that, because that is so true. It is, when you have FHA loans, you have to get exactly what you said. You have to show where the money originated from. Go through every single stream. You have to get transaction histories from both the gifter and the giftee. And so you will have to show who gave the money, where it came from them. And then when you give it to the borrower, the buyer, they have to show it coming into their bank account. And it just turns into it's a very long rat race trying to get to where the money came from for FHA. Conventional, no big deal. FHA, you will if they're getting a gift, that's one of the first things you want to know in their buyer consult, or for me, when my first borrower consult, will be asking about the gift, because you will want to start tracing that instantly. Otherwise, it could be a rat race at the very end towards closing, and you'll be have to push closing because of it. So, not fun, but fun, right? Thank you for sharing that, Kaylee.
You're welcome.
One other thing, while we're on this, make sure your buyers don't go buy new appliances before they get in their house. It can ruin a whole deal, especially FHA. This happens quite often around here. You see someone open up a Nebraska Furniture Mart. Why? It's 0% down payment, 0% financing, and you can have 10% off if you open up a card for appliances. If you open up that card, put all of it on this card, guess what? We do what's called a credit refresh within 3 days of closing to see if any new lines open. If it does, you have to include all of that debt in your monthly obligation for qualifying. It can ruin a deal within 3 days of closing because you opened up a card early. So we always tell people, wait until you are clear to close, or the day before closing, to go buy appliances, because it could ruin a deal if your debt to income ratios are right on the border and close. Some people, it doesn't matter. They can afford to do it before. Other option is just buy it with a debit card or cash, or just wait. So, but make sure never have someone go open up a card without talking to me or you first, because it could really ruin their purchase. All right, different loan programs. We'll go over each one of these real quick, just so you guys kind of know. You have your normal conventional rate, your mortgage, FHA, USDA, and VA. What a conventional mortgage is. Everyone wants to be conventional right now. You almost have to. Why? There's a difference in a conventional and FHA mortgage appraisal. A conventional appraisal is a lot less strict. It just kind of looks more at the value of the house and makes sure that it is right. An FHA mortgage, they make sure that the house, and VA is the same way. They make sure the house is safe. You can't have any peeling paint. You can't have any rails that are loose. You can't have any steps that have nails sticking out of it. Very random rules that could really cause a deal. That is why a lot of home buyers or sellers right now are weary of FHA. So the conventional mortgage, like I said earlier, anything above 680 credit will try to put you conventional. Why? It just helps you, one, as a buyer, and two, you get lower interest rate and you have fewer cost. Your closing costs are a lot lower. Everyone wants to be conventional if they can. FHA, what FHA is for is a lot of first-time home buyers or people with lower credit. If you have credit below 680, we will probably put you in an FHA loan. Why? There's a 3.5% down payment that's required instead of a 5%. If with a conventional, there is also, I'll get to it in a second, but with conventional, you have a 3% down payment options for first-time home buyers. Otherwise, it's 5%. FHA, 3.5% down. It's a lot easier to qualify. Your debt to income ratio can go higher. And so it's just easier to get into the mortgage. USDA, what this is it's for rural areas. You can get into it as little as 0% down. It's very good if you have people buying in Gardner. It's the cutoff in Kansas City in the south. In Missouri, it goes out to like Lone Jack, Missouri, anywhere kind of east of Blue Springs area, Lee Summit, anything east of that starts to become rural, and you can use the USDA loan. Anything north of Baser in Kansas, anything north of Platte City in Missouri is USDA. VA, anyone that is active military or a veteran can qualify for VA. One thing that's good about that, 0% down payment and low interest rates. I'll go over each of these a little bit more. Conventional, kind of what we just talked about. Minimum down payment of 3%. For a first-time home buyer, there is an income limit on that 3% program of $68,000 for Kansas, and I think it's $65,000 from Kansas City, Missouri. It depends on each county. It takes the area median income, and then it gives you 80% of that area median income, and you can get to that. So you'd be at $68,000 in Kansas for a 3% down program. Conventional mortgage, what is good about it? Low interest rates are lower. And one big thing is the PMI or mortgage insurance falls off when you hit that 80% loan to value, right? Like kind of what we talked about earlier. With FHA, we will get there now, is the mortgage insurance with FHA stays on for the entire loan, the whole time that you buy it. So FHA, 3.5% down, debt to income goes to 50%. And you can, the way that you get in, it's just easier to get in with people with lower credit. It also is worse when you look at it as a seller because your FHA buyers usually have the worst credit and not as much to put down. That's why they're FHA, not conventional, right? But it's good when you have a first-time home buyer trying to get in or someone that's credit is hurting. What the difference between FHA and conventional, the main thing is the mortgage insurance. With FHA, you have an upfront mortgage insurance premium, meaning on top of your monthly payment, FHA adds about $4,000 to $5,000 depending on the loan amount to the top end of your loan. And so, for instance, if you buy a home for $275,000, your mortgage is at $275,000. Your new mortgage is going to be around $279,000 just because you went FHA. Does that make sense? So you have an upfront mortgage insurance premium of 1.75% of the loan amount, and on top of that, you have a monthly mortgage insurance of 0.85% of the loan amount. So usually around $150 to $200 a month, depending on the size of the house. Or if you get a bigger house, say $350 to $400, you are looking around $300 a month in mortgage insurance, plus an upfront mortgage insurance of $5,000 to $6,000 at that price point. So that is the main thing about FHA that gets tough on borrowers is they get hit with that upfront mortgage insurance, and then the monthly mortgage insurance stays on for the entire life of the loan. So it'll never ever fall off. The only reason we put people FHA is if their credit's not very good and their debt to income is high. If their debt to income's high and we can qualify them FHA, we will, or if they have bad credit. With FHA, sellers can contribute, this is a big one, up to 6% of closing costs. With conventional, where we were just at, they can only put up to 3% down, okay, of seller paid closing costs. With FHA, they can contribute up to 6% of closing costs, meaning they will turn around, they can give you all of the closing costs paid for. Any questions between FHA and conventional? Because that's the main two that everyone hears about.
So what if you have a low credit score, but you can put down a really high down payment? Then
It depends what your credit score would be.
Say it's like 600 and they can put 20% down.
If you're 600 and you can put 20% down, I would advise you have to go FHA. The minimum credit for conventional is 640 to even think about it, and that's if you can qualify with that. So you'd have to go FHA at that point. At that point, you'd almost look at, hey, is it smart to put all 20% down because you still have to pay that mortgage insurance, or would we just put 10% down, and because mortgage insurance is going to be the exact same,
Right.
save that 10%, rather pay off other debts to get your credit score up, or save it and try to get to 640. And then once you get 640, we'll refinance. We'll come in and refinance, get you conventional, have that
Okay.
mortgage insurance fall off, save you $300 a month, use that 10% and pay for the closing costs of the refinance at that point.
Okay.
Does that make sense?
Yeah.
So great question. Teresa's in here. Teresa, sorry. Did I say that right? Parisa. It's a pear. Pear on her arm. Parisa. She's in here. She asked if you have the money to put down 20%, but you only put down, but you have a low credit, what would you do? Would you stay conventional or go FHA? And that just depends if you're above 640 or below 640. Any other questions? Nope. Cool. Keep going.
Yes, I have a question.
Yep. Let's hear it.
Sorry. I wanted to know, can you refinance at any time, or is there a certain
Great
time
question.
frame?
Yep. So you have a 6-month waiting period from the time you purchase a home. So let's say you buy a home right now in June, you could refinance come December. Let's say you buy January 1, you can refinance come July 1. So you have a 6-month waiting period. So it's really not that long. This happens quite often. We get people into the FHA just so they can qualify. You don't have to make a mortgage payment for your first 2 months of a mortgage. So if you close June 1 or May 1, it's coming up 2 days. It's weird, crazy. If you close May 1, then you don't have to make May or June's payment. Your first payment is July 1. Well, then you only have 4 months of making payments of this FHA. Then you can turn around and refinance into conventional after that. Great question. Any others? Cool. USDA. It's more rare with us being on the plaza. This is more rural. I've done probably 4 or 5 of these in the past year. The cutoff is good to know. Like I said, the cutoff is literally the Gardner line in Kansas, and half of Gardner's in it, half of Gardner's out of it. Spring Hill, some of Spring Hill's in it, some of Spring Hill's out of it. So you have people looking down there. It could make sense for them to do this program. What is unique about USDA? You can get in with lower credit scores, just like FHA. The interest rates and the closing costs are lower. So it's a great program if you qualify. Where it gets tough for qualifying is the household income is different. So let's say you have a husband and a wife, but you only have the husband on the loan, not the wife, because the wife's credit is lower. Let's just say it's lower. She can't qualify. She doesn't want to be on the loan. You have to use the total household income still. So you have to use both of their incomes and both of their debts for qualifying. If your incomes if you make 115% of the median income for that, or the median area income, which for Kansas, like I said, is right around that $68,000 for the Kansas City area. If you can go up to 115, so it's right around $85,000. If your household makes more than $85,000, you essentially won't qualify for this USDA program because your household makes too much money. So it's strictly for people in rural areas that make lower income. you can qualify for a 0% down program. That is a great program if you qualify. It's just the qualifying part is what's tricky. So you have anyone in those areas that are lower income that have problems with down payment? It may be a good problem, and we can talk about it. Someone just got sell. Good job. So, any questions about USDA? One thing to really remember that is just that it's in a rural area, and the income has to be essentially the household income has to be less than 100,000. From there, if they need help with 0% down program, that's where we would more look at it. 0% down rural area. That's all you need to know for USDA. And last one, VA. With VA loan, you have it's for veterans and for people that are active military. It is a great program if you qualify. Why? You can put 0% down and have no mortgage insurance. They have a one-time financing fee, a VA fee that is rolled into the loan. It's like the upfront mortgage insurance, so you have a one-time VA fee, but it is not as much even close to as upfront mortgage insurance. And their interest rates are extremely low. They're in the mid twos right now when everything else is high 2s to 3. They are extremely low interest rates. You can put 0% down. You can roll closing costs into the loan amount. So you can literally, with the 0% down, roll the financing fee in, have seller pay closing costs. You can come in and make money. You can actually get money back at closing. I had a veteran out in Wichita that closed on a loan and made $1,000. They bought a house and got $1,000 back in cash and had a rate of 2.75. It's a great program if you have someone qualified. It's just they have to be a veteran or an ex-military or in the military active duty right now. Any questions on VA loans? Keep going. Cool. So that's the main 4 different types: conventional, FHA, USDA, and VA. They all do the same. The main difference is the appraisal and the amount that you can put down. One thing to remember, VA loans, this is actually very good to remember. The thing that's tough with VA loans is the appraisal is very, very tough because they want, as a VA appraiser, you are usually another old veteran as well. The VA has to be deemed safe because they are part of the military, where if you have anything, a loose piece of wood, a rail on a deck that's not great, a chipping paint, literally anything at all, they will have you fix it before you close on the house. You have to fix it. And so the VA appraisals are very, very tricky appraisals. They usually come in, the value is usually good, so that's a good thing, but it usually just comes in subject to completion of the projects instead of an as-is appraisal. That makes sense?
So is it not very competitive right now?
They are, because it's tough. Yes and no.
Would you move someone from VA to conventional?
If someone can qualify VA, I'd almost always have them VA because it's just such it's such a good program.
I just meant like right now.
Yeah. With a conventional mortgage, with this market, she asked would you do VA or conventional? That's actually a good point. Maybe you want to do probably conventional because you don't want to do anything or you're waiving your appraisal anyways to get a house, right? Mm-hmm. So if you can do conventional right now, always do conventional. So great question though. All right. Almost done, I promise, guys. The financing process. Now, this is how when you guys have your he's clapping. Woo, Tanner, going too long. Oh, Matt, is that a raised hand or a clap?
It was both. I was trying to raise the hand, but I hit the clap, and it was just bad timing. I promise. I was just gonna about the.
You're talking too long. Let's hurry up, Tanner.
No, not at all. With the VA loan, I forget where this was said, but somebody had mentioned somewhere that they put in an offer for a conventional loan because VA loans it's harder to get people to accept them because of the inspections and stuff like that. But they were able to, qualify with the conventional loan and then switch back to a VA after qualifying and getting their offer accepted.
You can do that. It's kind of, I'm not going to come out and say it out loud, really, that it's something you should do because you're switching on your contract, but it definitely happens a lot right now because you.
Oh, gotcha. I didn't realize it was a frowned upon activity.
Oh, it's not frowned upon at all. I mean,
Oh.
It's just like, do you want to put conventional on the note just to get it? It may, I mean, do you want to put conventional on a contract knowing you're going to switch to VA after you get the contract? It's kind of what it is, Is that what you're saying?
Yes.
Yeah.
Just to get, make your
Just to
offer
move
more
quick.
competitive.
Yep. Yeah. I mean, when I talk to them, I'll be qualifying for both, no issue. Most time, if you qualify for a conventional mortgage and you are a veteran, you qualify for a VA as well. And so it's the exact same thing. But yes, that's definitely an option. So the financing process, steps 1 through 6, just kind of like your guys' buyer's meeting. I work with your buyers, right? So once you guys have your initial consultation, then I have my initial consultation. Then we go right after the initial consultation, we go into our qualifying, which is our pre-approving, getting all their documents, approving their documents, making sure everything's good. You guys go out and find the house, you get it under contract. Once it comes back to us, we send it to our processing team. What processing is, they process the loan, get all the documents, everything dialed in, send it to the underwriters, they review everything. We get it dialed in with our closers, and then we close. So we'll go over all more real quick. So initial consultation, what that is when I meet with my borrowers, right now, a lot of times I Zoom with them because can't meet in person. I like to go over the whole application with people, show them how we get our rates, show them what their debt to income ratios are, show them everything about the loan and show it visibly to them so they know how we qualify. A lot of people don't know how they qualify for a mortgage. You just call your mortgage guy and say you qualified up to $300,000. I like to show people why they're qualified for that because then they don't argue it down the road. They know exactly where they are. They know where their budget is. They know what they can afford, and we can go from there. And so when we meet with them, we ask them all the simple questions. How long do you plan on living in a home? How much down payment do you need? How much do you want your monthly payment to be? And then we kind of shape it around where they are focused on it. They're focused on, hey, we're only going to be here for a year. We just want to get in with the lowest amount possible, get our closing costs almost covered, and know we're going to sell in a year. Cool. We'll shape our conversation around that. Hey, we only have 3% to put down. Cool. We'll shape our conversation around that. It's not as much monthly payments, down payment. Hey, we want our monthly payment to be the same as our rent, $1,200 a month. What's our budget? So whatever that is for the buyer, that is where we will then shape our conversation to see where they are and to help them. After we have that, almost the same process, we always have them start uploading their documents. When you pre-approve or qualify for a mortgage, we're verifying your income, assets, and employment. And so when you verify all these different items, it's where you go through your checklist of, we have to have 2 years history of W-2s. We have to have 30 days of pay stubs to qualify. A picture of your driver's license, making sure that you're employed for the last 2 years. We have to have 2 months of bank statements. Like I said earlier, you have to have all those bank statements to verify where it's from. If you have any stocks, investments, anything at all, we will have to collect those. And so, yes, it's a lot of documents. What I am doing right now, and a lot of lenders are doing, with Fairway at least, is we are getting these documents and we are getting them at our initial consultation. I've harped on it millions of times now in our TBD pre-approval program. What this means is as soon as we consult with someone, we are verifying all of these items on this list. We're getting all of these items from them right at the front, and we are submitting it through as if you already have a contract, from verifying these to our processing stage. Meaning I'm getting everything, I'm sending it into our processors, she's looking at it, getting it dialed in, getting the whole file dialed in to the point where we can get you approved without actually having a contract. Now, in a normal situation, when you are pre-approved, after the pre-qualifying or pre-approval stage, you go out, that's when I call you guys back, right? You call me, you have a lead, I get them in, I meet with them, get them pre-approved, get all of their documents. I call you, say, hey, they're good up to $300,000. They like 250 to 280 is their range because they want to keep their monthly payment around this and this. We're gonna put them our TBD pre-approval program, and that's like, great, sounds good. Then you guys go do your thing. In the background, while that's going on, we are in our processing stage. And what processing is I have my assistant on my staff, her name's Jacqueline. She goes in, verifies everything that I've already had, gets everything looked at, gets everything kind of wrapped up in a present, and then ships it on to the underwriter. And so when the underwriters get it, what an underwriter is it's someone that, once again, just verifies everything. They go through Fannie Fannie Mae and Freddie Mac guidelines. They go over everything to just confirm that what we do is approved. Once the underwriter looks at it, they rather get their stamp of approval or they send it back to the loan officer to say, hey, this isn't right. You guys got to fix it. In our TBD pre-approval program, the reason I keep harping on it is it goes through steps 1 through 4 without you having a contract. That way you can be all you have left is closing, essentially, after you go through steps 1 through 4. And we will get you all the way through there. So when you make an offer, we can be like, hey, look, the underwriter's already given this clear and close. Like the underwriters cleared they verified their income, assets, employment, everything. And so now all you have to do is get a contract file under contract, and then we will order the appraisal, get it submitted, and be good to go. And so underwriters look at it, verify everything. After they verify everything, they usually ask the borrower for updated documents or just something of me, making sure that we are verifiable, good to go. Then we go to our pre-closing situation, where I send them an initial CD, which is just all the information on the loan, what their numbers will look like, the title right before we bounce, everything that we have done, send them all their numbers, make sure everything is good, have them verify that, and then we send it off to title, where title and the mortgage company balance out the final disclosures, balance out everything, and get the numbers dialed in where we then can give you your borrowers the closing numbers. Then we go close. All they need is their photo ID, and they go out and sign everything. We buy them those pretty gifts. You guys shake hands with them, make sure they give you 2 or 3 referrals, and then we go to the next one. So the process is very simple. The consultation stage, pre-approval stage, verifying all their assets in the processing stage, give it to the underwriter for a final approval, and then you have your closing and your post-closing, your pre-closing and your post-closing. So very simple process. It usually takes 30 to 45 days strictly because the appraisal that we order, one thing that's of note, that's great to know, when you have an appraisal, it's not just me sitting in my office calling up an appraiser saying, hey, can you come do this in a week? I cannot talk to an appraiser. Even though I'm a lender, I order it, I cannot personally talk to them and talk value with them because that is against the law for me because they can skew the value. Happened a lot in 2008. They changed that law in 2008 because all the mortgage guys just call up their buddies, say, I really need that 350. Come on. Doesn't allow anymore. So we have a third-party system that we go through that orders all of our appraisals. I will give you a due date on that. That's the only time I talk. That's all the people I talk to. It's a third party. They contact the appraiser. The appraiser comes out and does the house. It's the only thing we can do. If you want to fight an appraisal, it's a very easy process. We get 3 to 5 comps straight from the MLS page. Have all the 3 to 5 comps with you on the MLS page. You send it to me. I send it back to the appraiser. The appraiser looks at it. They have to get back within 48 hours with a new value, or say, nope, your comps don't work. This is what our number is. Any questions on that? Cool. We're wrapping up. Oh, Matt, I saw you. No, Matt, come on.
I was just going to respond. No, I didn't have any questions.
Cool. All right, post-closing. Kaylee, kind of what we talked about earlier. You have 2 months without a mortgage payment. So you close May 1, you don't make May or June. First payment is July 1. If you close May 31st, that still counts as the month of May. So you don't make May or June. First payment is July 1st. Does that make sense? So it goes by months, not by date. And then so if you close June 1, well, you don't have June and July, it's August 1. So you don't have your first 2 months. That meantime, I will contact them to let them know where their payments are, how to set up auto payments, doing all of that. So you guys don't have to worry about anything with the mortgage. Kind of we talked about earlier, 6-month waiting period so you can refinance. That's because a lot of times your mortgage is rather sold or it hasn't even processed yet because that's at 2 months of trying to get it processed and get your payments rolling. After you have that 6 months, it's now yours. One good thing to remember is after 1 year, you can consider your you can rent out your primary residence into an investment property and buy another primary residence. But you have to wait 1 year on that. Does that make sense? Did I lose you? All right. So if you buy a house, let's say you buy a house for June 1, you have to wait till next June 1. Then you could rent out that house and buy another investment property, another primary residence, and that can be included in an investment property. If it's less than 12 months, you have to keep in that primary residence for 12 months.
Okay.
That makes sense?
Mm-hmm.
Cool. I have a system that's called HomeBot, which each month sends your borrowers or buyers a updated system, update what their house value is, what their equity is, if they refinance, what it would look like. Just an updated CRM that if you guys have any questions on that, let me know. Or your buyers love it because it tells them basically when they should refinance, if they should sell their home, how much equity they can get, if they sold their home today, and it updates for it so we don't have to worry about it. And I always follow up in April. You get tax write-offs for buying a home on mortgage. You can write off all the interest that you paid at closing, some closing costs, and all the interest that you paid throughout the year. You can write off on taxes for the following year. So it's a great advantage, tax advantage when you're trying to save some on that and write off some different items. So that is that. This is everything wrapped up in one. I will send this out. I have a PDF of this information that is basically the loan process from step one until the end, where you go from the pre-qual to meeting with you guys, applying everything, getting under contract, having the appraisal, getting to underwriting, step for step, how it happened and how you can go through the mortgage on our side. You guys do the inspection. The one thing to remember to tell your buyers, inspections are with you guys. They're not required for a mortgage. They're highly, highly recommended. I tell everyone to get them, but that is not paid in closing. That is paid out of pocket now with you guys, that you guys do. Appraisals paid at closing through us. But all the fees and everything else is paid at closing with us, but the inspections are with you guys. Is that cool? Makes sense? All right. Any questions? That is the home buying process on the mortgage side. It's very fun. I enjoy it. I enjoy being with all the clients. I like it. I'm kind of nerdy with numbers. So it's fun when you get people qualified. But do you guys have any questions mortgage related?
No, sir.
Awesome. Come on, Kaylee, Lisa, Emily. Emily, is she listening still? She looks at you. Oh, she's listening. I thought she turned you off an hour ago.
No, I do want some more info on that HomeBot stuff though.
Cool. I'll shoot you that. I mean, it's super easy. As a realtor, it's actually good for you guys that are just new to the business because you get 25 for free. So I pay for it. You get 25 people, your first 25 buyers you can put on for free. After that, it's like $15 a month, or I think $25 a month for a real estate agent to add all of their buyers to. But it's great because it sends them monthly and it has a 90% open rate because it literally is so cool value on the house. You guys can sign up for it if you want as well, just personally, because it tells you what the value of your home is. If you refinance, what your interest rate would be, how much money you would save, what your monthly payment looked like. If you Airbnb'd your house, what it would look like, what your cash flow would be on it. If you sold, it tells you how much it would be. They click on a button and it comes up to your name because you're the agent on it. If they say, hey, can I get how's my neighborhood doing? They'll send an email to you guys and you guys can be like, ooh, well, this house sold, this house sold, this house sold, and come get listings that way with past clients. So I will send you the HomeBot information, Emily, after this. And I'm literally sitting right behind you. So hopefully you can just like turn around and look at it too. Elisa, Kaylee, anyone?
No, nothing from me. Thank you very much.
Yeah. I'll send a follow-up email with each of you guys. I'd love to meet you all in person at some point. Just because I've been in this office and I haven't had a chance to meet all of you guys. So I'd love to take you guys out for coffee. Big coffee guy here. And so let's do it sometime. But thank you guys for jumping on. I know I went a little long. Any questions you have whatsoever, give me a call or text anytime and we'll get them answered for you.
Thank you.
Thank you guys.
Tanner. This was
have
awesome.
a wonderful day. Hopefully you guys get some houses under contract this weekend. Woo! Good luck.
All right. You have a good day too, man.
All right, we'll see y'all.
Bye-bye.